After the passage of the U.S. Constitution, Ben Franklin famously remarked that while the Constitution appeared permanent, there were really only two permanent things in life. Those would be death and taxes. Today, we're going to take a look at the federal income tax. Well, let's get started. Okay, let's take a look at some preliminaries. The federal income tax started in 1913 with the passage of the 16th Amendment. The U.S. Archives notes that due to exemptions and deductions, less than 1% of the population paid income taxes. It also notes that tax rates began at 1% and rose as high as 6% on incomes over $500,000, again at the time in 1913. Now, sitting in front of you is the 1040 form that existed in 1913. Every government publication, to make it easy to keep track of, has a form number, if you will. And the 1040 form is the form on which we write our income, the tax we're expected to pay, the tax that we have paid, so that we can make sure we've met our obligations to the government. In the lower left corner of this form is a table that shows the income ranges a person is earning and the tax percent they're expected to pay. So what I'm going to do here is zoom in on it and show you this area here that has the tax rate moving from 1% all the way up to 6%, again, as a person earns more money. So our tax system, dating all the way back to its origination in 1913, has been progressive. So the idea of progressive taxation is that the more a person earns, the greater their ability to pay tax, and the greater tax rate we will collect from them. Now, income and taxation is complicated. So I want to set out right at the beginning the types of income that will be subject to the taxation that I'm about to show to you. So the first thing is our earned income. Wages, salaries, and bonuses are examples, and that's what is the lion's share of most of the income we receive. But it also pertains to interest that we might earn from owning bonds, as well as profits we've achieved on stock holdings that when we sell them, we've held them for less than 1 year. Income that is earned from investments held longer than a year, as well as dividends received from holding stock, they're taxed according to a separate schedule or table known as the long-term capital gains tax rate. Okay, who's ready to dive in? In front of you is the federal income tax table for income earned in the year 2023. Now, if I was to ask 100 adults how this worked, I would bet 90% of them would get this question wrong. For example, here's my question. Take a look at the table and see if you can answer. An adult earning $100,000 will pay what rate of tax and what tax actually in dollars at the end. So let's take a look here. We can move down this range of incomes and see that that $100,000 of income sits right here. So surely if we have 100,000 in income, then at 22%, that person is going to pay $22,000 in tax. That's all good and wonderful, but it's also incorrect. Now, why is this incorrect? Let me see if I can illustrate through some examples. If I have a couple making $10,000 in a year, their income falls neatly between $1 and 22,000. So as expected, we would pay 10% in tax. What if I go up here and I enter $20,000? As expected again, 20,000 is less than 22, so their income is taxed at a rate of 10% still. But watch what happens when I go to $30,000. What happens is the first 22,000 of this couple's income is taxed at 10%, and the excess, and only the excess that spills into the next bracket, that 8,000 extra, is taxed at a rate of 12%. Now let's see if I can illustrate this a little bit differently. Let's say that the couple makes this odd sum of $89,450. If you notice, this sits at the upper limit of the second tax bracket. Now, let's also say it's towards the end of the year and they get the opportunity to earn a little extra income. Well, if they misunderstood how this all works, they'd be saying to themselves, well, if we make extra income, our income will fall into this third bracket, and everything we earn will be taxed not at 12%, but at 22%. We don't want people thinking like this. We don't want them acting against their interests just because they're at the edges of various tax brackets. And so, what we do basically is we tax people's income in brackets. Sometimes I refer to them as layers at different rates. And we move on to the next bracket when the prior bracket is fully completed. So here again, I'm going to illustrate what we mean. Again, let's say that this couple has the ability to make an extra 500 bucks, maybe by both working Saturday and all day Sunday at some kind of fair or some kind of big event. So I'm going to up this from 89 450 to 89 950. Let's see what happens. And so there, as we would expect, that extra $500 only is the income that is taxed at a 22% rate. Now, what this does is results in them owing a tax of $10,404 on $89,950 of income, and that is a tax rate of 11.57%, which is basically weighted average of the incomes as they fell into the various brackets. Now, it would be accurate for this family to say, well, you know what, we're just starting out in bracket 3, and certainly for the next $100,000 they could earn, let's say this year they reach the same income and then keep striving for more, will be taxed at a rate of 22%. So the rate that of each additional dollar that a family makes, that's known as the marginal rate. Each one extra dollar at this point, they have moved on to the 22% bracket. And so when they're thinking about where they want to dedicate their time and what dollars they might have after taxation, they need to be thinking about their marginal rate of 22%, even though they're actually paying a rate of 11.57% on their income. Now, there's one other significant aspect of the tax law that we need to talk about. The good news is that the US government provides for something called the standard deduction, an amount of dollars that we can subtract from our income that would result in our taxable income. And so for the year 2023, for a married couple filing jointly, that number is actually $27,700. So I'm going to enter it right now. And let's see what result that has on the tax obligation of this couple. Well, you can see the income, the taxable income has dropped dramatically down to $62,250, and that's the amount we have to apply to the table. So down here is almost like a cross check. If you see this number is 62,250, we're taxing the first 22,000 at 10% and the next 40,250 at 12%. The total tax obligation is $7,030, which represents a rate of 11.29% of the taxable income. But in reality, the couple made $89,950. And so the true tax rate, when you compare $7,030 to $89,950, is only 7.82%. Besides the standard deduction, the US government provides other ways for a family, especially to reduce their taxes. I'm going to illustrate this with the next tab. So on the right here is an additional panel, and it shows the effects of what is called a per child tax credit. Basically, American families are entitled to reduce their tax burden by $2,000 per every child they have under the age of 17. So here, for example, if this family has two children under 17, their tax burden will go from $7,030 to $3,030, further again reducing their tax burden. Now, while I'm still on this screen, I'm going to zero this back out and I'm going to come back up here. I want to discuss for a minute while showing you both the standard deduction and the per child tax credit on a single screen. Another interesting effect. It turns out that about 40% of American families don't pay any federal income tax at all. And I'd like to show you how this can be possible. the median income in America is somewhere in the vicinity of $70,000, meaning that for every family earning above 70,000, there's one earning below. So let me put a number in here as high as $64,000. If I do, what will happen is that we'll take the standard deduction and have the family having $36,300 in taxable income, which will generate a tax liability of $3,916. So if this family has two children, they're going to be entitled to a $4,000 tax credit. And in so doing, they will not actually owe the IRS any money, but the IRS will actually write them a check for the year. Now, we would be remiss in completing this video without looking at another extremely important aspect of the federal income tax system. Let's take a look again at these rates. They start at 10%, and we saw the first couple of uh, bracket increases. But if we go all the way down to the bottom, we see that the top marginal rate is 37%, and that is applied to any income that a married couple achieves in a year that is beyond $693,751. Now, in America, we've got a lot of people who make a lot of money, entertainers and athletes and whatnot. So let's enter a value here that could be in and around the amount of the NBA max contract and see how this plays out. So this athlete's making $48 million in a year and learns that over 47 million of it falls in the 37% tax bracket, resulting in a liability to the federal government in excess of $17 million. Now, this tax is going to be in addition to any tax that the state where the athlete lives in may apply. As we said earlier, there are 41 states that have their own income tax. Thank you so much for joining me on this journey into the federal income tax system. There's a lot going on, certainly. It's so important that we have knowledge of how we're being taxed, not just as taxpayers, but as citizens, so we can make assessments as to the appropriateness of the incomes and the taxes that our fellow citizens are paying and whether they are fair. If you notice at the bottom of the spreadsheet, I had a couple extra tabs to show you some additional information and aspects of the tax law, but we're just going to save that for a subsequent video. But if you've learned something today, please like the video and share it, as well as subscribe to the FinanciaLit channel. Till next time.